What if I told you that every single month, representatives from about 60 of the most powerful central banks on Earth fly into a discrete building in Switzerland to talk about something that could completely transform how you buy groceries, pay your mortgage, or build your retirement? No TV cameras are allowed, no press conferences, no live tweets. Yet what gets discussed in those marble-lined conference rooms in Basel could end up rewriting the rules for every dollar in your wallet. Ask yourself this. When was the last time you seriously worried that your dollars might not be accepted tomorrow? You probably never have. That quiet confidence comes from decades of dollar dominance so overwhelming that most of us can't even imagine a world where the dollar isn't the default choice. But what if those central bankers meeting behind closed doors are preparing for exactly that? A world where the dollar is no longer the unquestioned global currency everyone needs. These aren't routine discussions about tweaking interest rates or adjusting inflation targets. According to the Bank for International Settlements' own meeting schedules, these gatherings increasingly focus on crisis playbooks and stress testing scenarios that would have sounded absurd just 5 years ago. The scenario that keeps them up at night? A world where the US dollar loses its status as the global reserve currency within the next decade. Here's the part most people never hear. Christine Lagarde, Jerome Powell, and their peers are no longer debating if a transition away from the dollar-centric system comes. They're working on when and how it happens. Documents from central banking conferences show detailed contingency plans for managing international trade when the dollar is no longer the central pillar of the system. Our own government is aware of these discussions. They just aren't exactly leading the evening news. If this still sounds theoretical, look at what central banks are actually doing, not just what they say. According to recent World Gold Council surveys, roughly 3/4 of central banks say they plan to reduce their dollar holdings over the next few years. Why would conservative institutions that move slowly and hate risk adjust their reserves like that unless they expect the dollar's role, and potentially its value, to shift in a major way? The Bank for International Settlements has issued guidance through its innovation hubs on building alternatives to dollar-based systems. These projects aren't abstract academic exercises. They're practical blueprints for payment rails and settlement architectures that can run without relying on American currency. You won't see a countdown clock to post-dollar day in your favorite news app, because broadcasting these preparations too loudly could trigger the exact financial panic they're trying to avoid. But the clues are everywhere if you know where to look. Here's what should really make us sit up. Central bank governors have quietly stopped talking in hypotheticals about alternatives to the dollar. According to recent Federal Reserve minutes and speeches, private conversations are much less about exploring possibilities and far more about coordinating timelines and implementation phases. When the people who run the global monetary system stop asking, "What if this happens?" and start asking, "How soon do we flip the switch?" it's time for the rest of us to pay attention. Think back to when you first heard about Bitcoin. It sounded like a fringe internet experiment that tech geeks obsessed over. While most of us were dismissing cryptocurrency as a fad, central banks were quietly building something much more powerful behind the scenes. Systems designed to make the traditional dollar-based setup optional rather than mandatory. In China right now, millions of people buy their morning coffee, tap in at subway stations, and receive government salaries using money that exists only as lines of code. According to the People's Bank of China, the digital yuan has processed trillions of yuan in transactions, adding up to hundreds of billions of dollars worth of payments that completely bypass the traditional banking networks most of us still rely on. In just 1 year, digital yuan transaction volumes jumped from under 2 trillion to around 7 trillion yuan as pilot programs expanded. Workers across numerous provinces receive salaries in digital currency. Students pay tuition with their phones. Everyday spending, government transfers, and business payments all move across an entirely new monetary system that didn't exist a few years ago, one that can function with or without the dollar. And it's not just China. The European Central Bank has accelerated its digital euro work far faster than its cautious public messaging suggests. While headlines focus on inflation, interest rates, or debt debates, technical teams in Frankfurt are running stress tests on systems meant to support the entire European economy on programmable digital money. Think about what that means in your daily life. Right now, if you send money internationally, you pay steep fees and sometimes wait days for the transaction to clear. These emerging systems, central bank digital currencies, and new cross-border payment platforms are being built to settle transactions in seconds across continents with dramatically lower costs. The Bank for International Settlements (MBridge) project, for example, has reached a minimum viable product stage. That's a dry, technical way of saying it's already capable of handling real transactions between central banks in real time, across borders, using digital currencies instead of traditional dollar-based pipelines. Here's where things get even more serious. Russia and Iran have already completed major energy deals using cryptocurrency and alternative settlement systems, explicitly designed to work around the dollar. We're talking about billions of dollars worth of commodities moving through networks that treat the U.S. currency as optional, not central. The BRICS bloc has announced the development of a bridge payment platform that connects member countries without touching the SWIFT system that underpins most traditional international payments. Brazil's systems now link with India, China, and Russia in ways that allow payments to move in local currencies, digital units, or regional arrangements where the dollar is just one of many options. More than 20 countries are now able to process international payments through frameworks where dollars are no longer required by design. What makes this shift so powerful is that the technology keeps improving, while the traditional banking system still runs on infrastructure that feels stuck in the 1970s. When you send a wire transfer today, you're using messaging standards created before the internet became mainstream. New platforms leverage advanced cryptography, automation, and AI-driven compliance checks to offer speed and security that our legacy systems can't match. Central bankers have stumbled on something especially important. Digital currencies don't just copy existing money in a new format. They enable entirely new economic relationships. Once money becomes programmable code, whoever designs and controls that code gains enormous influence over global commerce. And increasingly, that control is being shared by a broader group of countries, not just the United States. Pop quiz: can you name the economic alliance that represents nearly half the world's population and a significant share of global GDP, and has openly stated its goal of reducing dependence on the dollar? If you answered BRICS, you're ahead of most people who barely recognize the acronym. Here's a symbolic shift that should really get our attention. Saudi Arabia, the country that helped cement the petrodollar system by pricing oil in dollars, is actively exploring and participating in payment systems that can bypass the dollar completely. When the nation that helped make your currency globally dominant starts testing ways around it, that sends a loud signal. Imagine you're planning a European vacation for next year. Traditionally, you assume your dollars are as good as gold anywhere you go. But what happens if, by the time you travel, European businesses and payment platforms prefer digital euros or local currencies because they're cheaper and faster to process than dollar transactions? Suddenly, the global currency in your pocket doesn't feel quite so global. According to CBDC and payment system trackers, BRICS countries and their partners now conduct large volumes of energy trade and commodity deals in non-dollar arrangements. Russia sells oil to China and gets paid in yuan, which it uses to buy Chinese goods. India pays for Russian energy in rupees, and those rupees turn into purchases of Indian products. These closed-loop systems function entirely outside traditional dollar-based settlement. It doesn't stop at energy. New development banks and regional financing institutions have authorized hundreds of billions of dollars worth of projects in non-dollar currencies. Bridges, ports, power plants, and rail lines across Asia, Africa, and Latin America are being funded and settled without routing money through New York or London. Central banks are also quietly redesigning their reserves. Poland, for example, significantly increased the share of gold in its reserves over a short period. Other countries like Turkey and Kazakhstan have followed similar paths. These aren't minor tweaks. They're rapid shifts away from an exclusive reliance on dollar-denominated assets, the same types of assets that anchor many retirement funds and institutional portfolios around the world. Meanwhile, entire sectors of the private economy are adjusting. Major German automakers have restructured billion-dollar supply agreements with Chinese partners to settle in euros and yuan instead of dollars. These aren't small experimental pilots. Entire supply chains for vehicles, including the electric cars you might see at a local dealership, now function through contracts that never touch U.S. currency. The savings on currency conversion and transaction costs can reach hundreds of millions of dollars. For corporations, the question has flipped. 5 years ago, companies had to justify handling large transactions in anything but dollars. Today, it's increasingly common for executives to ask why a deal should be in dollars when alternatives are cheaper, faster, and face fewer geopolitical risks. The trend is especially visible in energy and commodities, which ultimately influence the prices you pay at the gas pump and the grocery store. Russia's energy exports to major Asian buyers have surged in non-dollar settlements. The crude oil that eventually ends up refined and sold as gasoline in your city may have changed hands in yuan, rupees, or other currencies along the way. Shipping companies have discovered that accepting payment in multiple currencies and plugging directly into regional settlement networks can increase profits and reduce risk. The container ship bringing goods to your local store might be financed, insured, and paid for entirely in non-dollar currencies, with automatic conversion handled in the background. Even universities and educational institutions have begun conducting tuition payments, research funding, and exchange programs through arrangements that avoid dollar dependency. For future students studying abroad, the financial system behind their education could be running entirely on regional currencies and digital platforms, where the U.S. dollar is present but not privileged. Behind all this, corporate treasuries are changing how they think about cash. Firms with significant exposure to BRICS and other emerging markets are building parallel treasury systems optimized for local currencies and digital settlement rails. These systems are designed to keep operating smoothly, even if traditional dollar-based channels become more expensive, less reliable, or temporarily unavailable. While most people argue about domestic politics on social media, a different kind of construction boom is happening out of sight. The building of a parallel financial infrastructure that doesn't rely on American control. Deep under oceans, new fiber optic cables are being laid along routes that connect Asia, Africa, the Middle East, and Latin America without passing through the traditional hubs once dominated by Western telecom and financial centers. These cables don't just carry video streams and emails, they're also high-speed financial arteries that can move payment data and settlement instructions over networks that don't depend on U.S. infrastructure. In Singapore, one of Asia's largest clearing and settlement hubs is rising on reclaimed land. When fully operational, it will process trillions of dollars worth of international transactions each year, without routing everything through New York or London first. Hong Kong has quietly transformed parts of its financial district into dense clusters of data centers and transaction engines built for cross-border payment systems that don't need dollars to function. According to BIS project reports, these systems maintain real-time links to central banks across Asia and the Middle East, creating 24/7 settlement networks that never sleep. The Asian Infrastructure Investment Bank has launched settlement facilities that handle project financing across dozens of countries through systems independent from traditional Western institutions. The highways, ports, and power grids built with this money are not just physical infrastructure. They're proof that large-scale development can happen without going through dollar-centric channels. Oil storage hubs in the Gulf are installing new pricing and settlement mechanisms that can transact in yuan, euros, or local currencies, giving producers and buyers more options. Ports across Southeast Asia are integrating cargo tracking with regional currency networks, so that the moment a container clears customs, payment is triggered in whichever currency the parties have agreed on. Even insurance markets are shifting. New products now help companies in Asia hedge against dollar volatility rather than the other way around. That's a subtle but powerful sign of how the center of gravity is moving. Conservative estimates suggest that hundreds of billions of dollars have already been invested in this new financial infrastructure. Networks, data centers, payment platforms, digital currencies, and regional banks designed specifically to reduce dependence on the dollar. None of this is hypothetical or in the planning stage. It exists today and is scaling up. The logic behind this post-dollar infrastructure is simple. As trade grows between countries outside the traditional Western core, they need systems that serve their interests first. Since the existing architecture was built around U.S. dominance, It's often easier to build something new than to remodel the old system to fit everyone's needs. All of this has led to a quiet but profound shift in the way global finance talks about the future. Have you noticed how financial commentary has changed? For years, analysts asked, will the dollar lose its dominance? And now the questions sound more like, when will it happen, and how fast will the shift be? Listen to the language of central bankers. When Poland's central bank announces firm targets for gold reserves, when Chinese officials talk about digital yuan interoperability in concrete phases, when Brazilian policymakers outline timelines for regional payment linkages, they're not describing wild experiments. They're mapping out implementation schedules. According to global CBDC trackers, dozens of countries are on track to launch or interconnect central bank digital currencies over the next few years. These systems are being tested, audited, and refined to work together across borders, often in ways that don't require dollars in the middle. Training programs for monetary officials now include modules on managing reserve diversification, operating multi-currency payment networks, and maintaining stability during a shift away from a single dominant reserve currency. They're not preparing for a remote, unlikely event. They're getting ready for a change they consider probable and, in many ways, already underway. Recent trade agreements increasingly include non-dollar settlement options as standard features. Emergency financial protocols in BRICS and other blocs can activate dollar-free liquidity support within hours if needed. Regular simulations test these systems, not to see whether they might work someday, but to ensure they're ready when circumstances demand. The most revealing signal may be what top officials no longer say. We hear fewer emphatic declarations about preserving the old dollar-centric order at all costs. Instead, we get calm discussions of diversification, resilience, and multipolar currency arrangements. By the time alternative payment systems can handle trillions in annual volume, and entire trade relationships function profitably without dollar involvement, the new architecture develops its own gravitational pull. Turning back becomes harder than moving forward. The question isn't whether the dollar will remain the sole foundation of the global financial system. That era is ending. The real questions are how quickly the transition unfolds, how prepared American institutions and citizens are for that shift, and whether we adapt in a way that preserves our prosperity in a world where the dollar is important, but not unique. Picture the year 2030. You're planning another trip abroad. Instead of worrying about getting stuck with bad exchange rates or foreign transaction fees, your banking app shows real-time options. Pay in the local currency at near-perfect rates. Settle via a regional digital currency. Or, if you want, still use dollars. Merchants prefer whatever option clears fastest and cheapest, and many of those options no longer involve U.S. currency at all. A Brazilian coffee exporter sells to a German buyer, gets paid in local or regional currency, then instantly uses those funds to purchase equipment from an Indian supplier. Smart software automatically routes the payment through the most efficient combination of digital currencies and regional payment networks. The entire process finishes in under 3 minutes. Dollars never appear in the chain. What does that mean for you? The coffee in your cup, the components in your phone, the energy that keeps your home warm, all increasingly move through systems where dollars are just one of many tools, not the central organizing principle. In this world, the United States loses some of the hidden advantages that come with issuing the dominant global currency. But Americans also gain access to more efficient payment systems and a less fragile global structure that doesn't depend on one country's policies. The transformation is gaining momentum because it serves the interests of many governments, companies, and citizens across the planet. Businesses save money, central banks gain flexibility. Smaller countries secure more say in how money moves through their economies, and ordinary people benefit from faster, cheaper, more reliable financial services. The signs are all around us. Every CBDC launch, every non-dollar trade agreement, every new cable and clearinghouse designed to support non-dollar flows nudges the world a bit further away from the old order. The post-dollar era isn't a distant science fiction scenario. It's the direction global finance is already moving, one transaction at a time. The real challenge for us isn't to stop it, because that's beyond any single country's power now, but to recognize what's happening early enough to adapt, protect our savings, and make smart decisions in a system where our money is important, but not the only game in town. Understanding these changes isn't about panic, it's about clarity. The better we grasp how the monetary landscape is shifting, the better equipped we'll be to navigate the financial world that's taking shape right now, whether most people see it yet or not.